You're listening to Confessions of a Bookkeeper, where we look at businesses through the eyes of their books. My name is Mark, your Chief Bookkeeping Officer, and I spent years cleaning up and reviewing some, let's say, interesting books. In this episode, we're going to get to know a medical professional with an entrepreneurial spirit. She wasn't a doctor, though. She was a nurse who had spent years in dermatology. She knew the patient side, the operations, and how a successful practice should run. And like a lot of smart people with her ambition and experience, she decided to start her own Medspa. She had been to every Medspa seminar and conference in the local area for the past few years. And if you've ever been to one, you kind of know the format. They walk you through the MSO and PC model. The professional corporation runs the medicine side, and the management services organization runs the business operations. They'll tell you about the basic requirements to run such a business entity setup, the management service agreement that's required and drafted by a contract lawyer, and they'll sell you on the ever-important EMR system, electronic medical record software, to handle the clinical side compliantly. It's a convincing pitch because it seems like it's ready to go in a neat little package, but those seminars don't exactly explain why the MSO exists in the first place and how to be successful with it. They teach the structure, for sure, yes, but the execution will always remain with the business owner. The MSO isn't just a protective shell for the PC, though. It's where the business equity should exist and grow. It's how the non-physician operator can build something of value, something that appreciates, so that one day, should the owner ever want to sell or otherwise attract outside money, that is actually possible and worthwhile for both sides. She followed every step perfectly. 2 entities, a lawyer drafting that management service agreement, and a clear path for business growth. But once she opened the doors, cash flow took over. As the PC started collecting revenues, the MSO sat idle. It wasn't that she forgot why the business were set up this way in the first place. It was because in a busy med spa practice, the owner is doing anything and everything themselves. In the convenience of the professional corporation's checking account holding the highest monetary balance, well, that's when things got a little sideways. When we reviewed her books, we immediately recognized a pattern we've seen many times before. The MSO had a single checking account, no payroll, no assets, no vendor payments, and a relatively low balance compared to the PCs. It was collecting a management fee from the PC each month, yeah, but those fees were just placeholders, not tied to actual activity, as there were no specific reimbursements as outlined in the 2 entities' MSA. The PC, meanwhile, was doing everything. It was paying both medical and administrative staff, rent, utilities, marketing, insurance, and even medical supplies, all from the PC's checking account. And while that might seem efficient and easy, almost none of it lined up with how their MSA or any other MSA would work. Under most agreements, the MSO is responsible for non-clinical employees and operational costs. We also found that the medical director's fee was being paid by the professional corporation, an entity which he of course owned, and that becomes a little problematic when the director was not on payroll and the business was an S corporation, and he would potentially get a 1099 as well. That's where the structure breaks down. When every dollar flows through the PC, the MSO never builds assets, income, or trackable value. All the operational activity and the risk stays within the clinical entity. On paper, it looked compliant, but in reality, it was hollow. And the person losing the most was the operator, because the MSO, her business that she completely owned, wasn't accumulating equity. This isn't about misunderstanding the MSO PC structure, it's about cash flow sequence and human nature. When the business opens, all patient payments legally must go to the PC's checking account, of course. So when the bills come due, your payroll, rent, vendor costs, that's where the money is, and that's where the payments get made from. It's not negligence, it's convenience. Everyone plans to fix it later, but by the time the systems are in place, it's already a habit, and the momentum is so strong, change becomes difficult. And the longer that flow continues, the less the MSO does, until it becomes just a name on a tax return, not a business in motion. That convenience carries a cost, not some compliance risk necessarily, but lost business value. Because every month the MSO sits idle is another month the operator isn't building something real in the entity they actually own. When she came on board with us, we didn't rebuild the structure, we activated it. We began with recommending a shift of all the administrative and operational functions to where they belonged. Payroll, rent, marketing, insurance, those all moved under the MSO. The MSO itself started running payroll separately, paying for the lease after it was reassigned, and managing vendors' accounts in the MSO's EIN and its name. Meanwhile, the PC focused only on the medical side, patient revenue, provider compensation, and the clinical staff. The MSO formally invoiced the PC monthly for management services, real invoices backed by real costs for medical supplies, and the percentage of revenue determined by the management fee. Cash flow was still tight at first, so the timing of the fee mattered. We aligned the MSO's billing schedule with the PC's revenue cycle, keeping both entities funded and predictable. It took a few months to settle in, but once the rhythm was there, everything stabilized. The operator could finally see her business not as one big account, but as two functioning companies, each serving its purpose. In less than a year, the difference was undeniable. The PC's book told the clinical story, services, staff, collections, and provider costs, and the MSO's books told the business story, staff, rent, marketing, and operations. That separation didn't just create clarity, it created opportunity. Because now the MSO had formal financials, its own profit and loss, balance sheet, and equity accounts. That opened doors that weren't there before. With legitimate financial statements, the MSO could start establishing business credit, apply for equipment financing, and even pursue working capital loans. And that's critical in a Medspa where cash flow ebbs and flows seasonally. The medical director was witness to these changes and took notice that his former nurse, now business operator, was taking this much more seriously, and it made that valuable relationship so much stronger, one that Medspa couldn't operate without. For example, having each invoice break out line items of rent, utilities, payroll allocations, software, marketing, even medical supply reimbursements, instead of one lump sum management fee, that level of detail eliminated confusion, it built transparency, and gave the medical director complete confidence in how the business was operating. The changes we recommended also helped streamline the doctor's finances as income was being reported correctly from the right entities. No longer was he going to get a K1 and a W2 and a 1099 NEC and a 1099 MISC from the spa. I'm sure his CPA was grateful as well. An unexpected benefit of the changes was independence. For our nurse client, the MSO standing on his own meant her business interests were finally distinct from the doctor's. If he ever stepped away or she decided to bring on a new medical director, the structure would stay intact. The business she built would keep running and her ownership would remain fully hers. MSOs don't fail from bad design, they stall when discipline fades. But when you operate within the structure that was intended, discipline turns into strength. The medical director benefits first. Their compensation comes through a clean 1099 from the MSO. Their tax reporting is simpler, their liability lower, and their relationship with the business clearer. For the operator, that same separation creates stability. The MSO pays its own bills, it runs its own payroll, manages the lease, and invoices the PC exactly as outlined in the management agreement. That makes the director transitions easier and enterprise itself more durable. A properly functioning MSO doesn't just keep you organized, it gives your business longevity. You can change directors, scale locations, or bring in new partners easier without dismantling the structure. And every month of disciplined bookkeeping helps to build real, measurable equity. Because this is where structure turns into value. When your books are correct, your agreements align, and the cash flow follows intent, the result is a company that can grow, borrow, or even sell. The MSO PC model isn't just compliance, it's control over your future. And when your books reflect that control, you build more than profit. You build value that lasts. At chiefbookkeepingofficer.com, that's what we build. Clarity that compounds. Because when your books are right, your Medspa doesn't just stay aligned with its MSA, it grows stronger every day.